For the next conversation on global opportunities and geopolitical risks, please welcome moderator Stephen Bertoni, Assistant Managing Editor, Founders, Forbes, and panelist Dambisa Moyo, Baroness and member of the UK's House of Lords and co-principal of Versaca, a family office. Oscar Fahlgren, Chief Investment Officer, Mubadala Capital, and Mary Callahan Erdoes, CEO, JP Morgan Asset and Wealth Management.
Good morning, everyone. Hello, everyone. Welcome.
Thank you.
Welcome to Iconoclast. I'm also excited to welcome all of our many virtual viewers who have just tuned in for this amazing event. How's everyone doing today? All right. I want to take a poll. Who is ready to hear a few billion-dollar investment opportunities right now? See some hands. Let's go. Well, we have a perfect panel, three amazing financial minds that have a full global view. And I'm just going to start and make it easy. I'm going to ask a question based on the topic. Dambisa, where are you seeing opportunities and what are you nervous about? Where are the risks?
Well, thank you. I'm delighted to be here again this year. I think the way I would frame it is, on the one hand, we have two super cycles that are in their early innings on AI, which was discussed a moment ago, and the energy transition. There's no doubt about it. Since the 1980s, we have not had really the enormous prospects and enormous opportunity that these two engines of growth could actually deliver. On the risk side, it's very well known that there are enormous constraints around the world. Very well known that the forecasts for economic growth from organizations like the IMF and even independent government continues to be weak and is expected to be weak for the next decade, or at least half decade. Issues around geopolitics, deglobalization are continuing to add costs and headwinds to the potential opportunities from the growth cycles that I mentioned a moment ago. In terms of regions, I think it'll be very interesting to hear what my co-panelists are thinking. From my vantage point, I really do believe it's very hard to bet against the United States. Of course, there's a lot of dynamics around the political side, but I think fundamentally you have a base in the form of investors who are putting real capital to work. And of course, there's a lot of discernment that's going to be required where the cost of capital is where it is. But I feel like, unlike many other places in the world, which I'm very interested to hear Oscar and Mary's thoughts on this, but I think the challenges of investing elsewhere and generating those returns on a risk-adjusted basis and delivering them back into wherever investors are, I think that model is fundamentally challenged since the world is becoming much more siloed. So I think there are opportunities in the United States. I'm excited about a lot of the AI opportunities, second order. So it's not just about NVIDIA. It's really about what does this do for the stack? What does it do for other sectors that have traditionally not benefited from technology, such as the healthcare sector, as one example. So lots of opportunity. And full disclosure, I'm on the board of Chevron, so I'm very closely interested in the energy transition, and there are enormous opportunities there as well.
Perfect. Oscar, what makes you excited? What makes you scared?
Listen, I think I'll split the question in emerging markets and sort of developed markets. I think when we look at the emerging market landscape in terms of opportunities, the world's gone through a big change. The BRICS are, some of them are almost impossible to invest in today. Russia's already off the table. China is complicated for a variety of reasons of geopolitical and otherwise. I think India and Brazil stands out for us, particularly for us. Brazil, I think we continue to see tremendous opportunities in that country, driven by a lack of capital, driven by they're sort of a little bit out of flavor with the world, and that presents very attractive opportunities if you really dig in and you're on the ground finding opportunities. So that's one of on the emerging market sector or emerging market space where I think we have a pretty attractive opportunity set right now. Particularly in green energy, where there is a tremendous amount of work being done in Brazil. I think on the more Western front, and risk, we continue to think, Europe has individual opportunities, but it's pretty sluggish in general as an economy. And I think when we look to the U.S., I'd say the opposite almost. U.S. continues to sort of power on against all odds in our view. But I think What worries us a little bit is obviously that, there's a tremendous wall of debt maturities coming up in the private equity, large part of it owned by the private equity industry. We're seeing a lack of exits and tremendous amounts of dry powder. So from an opportunity set, that is sort of dampening the opportunity set a little bit, I would say.
Wonderful. Mary, JP Morgan, what, 5 trillion assets you guys are shepherding?
Yes, proudly shepherding. But Steve, I want to thank you for running this panel, but I want to thank the real Steve, Mr. Forbes, and the whole Forbes family and the Forbes staff. This is a really special event, and they somehow hit it every year at this time when things are like, oh, they calm down from the first quarter, everything should be okay, we're headed into the summer, feels pretty good, and then, there's a lot of things at stake, a couple of interest rate moves, differentials shaking the world a little bit here. So,
wait, did you just call Steve Forbes the real Steve?
I did.
Oh, man.
But we're very appreciative that you always have us, all of us here, and with such great panelists. So I love this event. I learn a lot. I just learned a lot from the last panel. And I'll just tell you that you asked a great question. You said, what are you excited about? And I think, what are you afraid of? Yeah. Or something like that. Like, if those two things don't go together, you're not investing in the right thing. Because if you're not afraid of the thing that you're investing in, then it's probably already been figured out and the like. So you have to think about, of course you have your core portfolio, but you're asking about the things on the margin, like what's on the margin that could be exciting, but obviously is going to be a little stomach churning because it would probably be in the non-traditional space. And so I'll just take the opposite side for 1 second here. So Dambisa said, China as a place that's super hard to invest, and as a whole, I would wholeheartedly agree. Like, if you were just to sort of invest in the country, that's a hard thing given all the geopolitical issues, where they are in the cycle of their own interest rate environment, their consumer spending, real estate problems, et cetera. But having just come back from there, we have JP Morgan brings together about 1,000 delegates every year right before Memorial Day. And it's a place where you have the CEOs of the local Chinese companies, and then you have investors from around the world. This year, it was 3,000 people, and it was the highest percentage of international investors and international CEOs coming to explore. That doesn't mean it's ready for a bull market, but it means that people are starting to say what's scary, but what could be opportunistic. And you look at the things that are happening there. I mean, we all go to these places all around the world, as do many of you. And I remember after the great financial crisis, when we started to embark on EVs being something that the world was going to embrace. China said that they were going to do it. That was like 2009. The US really embarked on it in 2010. And 7 years later, you show up in Shenzhen, and 100% of the transportation industry, the buses, if you will, are EVs. 100%. That was 7 years later. That was in 2017. Now there's multiple cities in China that have that, and we're in 2024. Los Angeles has 2,000 buses and might get there by 2030. So you just say to yourself, like, there's a country that when they put their mind to something, it could be a narrow industry, it could be a narrow thing. You may not like the way they get there, but when they do, there are interesting opportunities that present themselves. And so we think that there's a lot of things that while the markets are nervous about the broader issues, you can find very particular stocks that can be super exciting. I would say the same for Europe. Europe is also a little bit hard. We've had the Swiss National Bank lower rates. We had the UK hold rates flat, but we've got the EU in general coming down, and I would just say they're a little bit ahead of the US. Remember that's what the US is waiting for, just a little bit more fodder to the fire to keep things going. So now you say, okay, wait, something happened, something changed. This could be very interesting. And you look at the multiples of even just take the pharmaceuticals, which you're heavily involved in the healthcare business, and you say, well, there's things like Norvo that has the Wegovy and the Ozempic, and then you look at the multiple of that, which is a fraction of the multiple of Lilly, and they're doing the same thing, and they have the same revenue growth rates in the mid double digits, and same profit rate. Why is the differential so much if they're selling to a global market? So it's because they sit in the region that they're in. And the same will go for emerging markets. And I think that's where, when you really get on the fringes, you say, it's been really hard to invest in emerging markets, particularly in the public markets, but now you start to think about what's out there in the private markets. How do some of these industries, big industries, especially on the energy transition space?
I think what you're mentioning is actually something we agree wholeheartedly with, in the sense that the average is not that attractive. The average over time tends to trend down to something that doesn't look worthwhile from a risk-adjusted perspective. But I think when you actually get it below the indices and below the public comps, and you're in the markets and you're looking for opportunities, both in emerging markets, but also in the environment that we find ourselves in the US now, there are tremendous opportunities for those that are willing to dig in and actually do, more bespoke deals. And I think the way we like to articulate it internally is a little bit that, as an investment community, to sort of fight against the vast amount of dry powder and the lack of exits in the market, in reality, what we need to do is sort of migrate up the complexity scale a little bit in order to generate alpha in a market where, the standard sort of auctions that are ongoing, it's just who bids the lowest cost of capital, and that game is not one that we're willing to engage in. Right?
When you all enter a new market, whether it's maybe an EV company in China or in Brazil, alternative energy, biofuels, how do you diligence? How do you find kind of a target, and how, again, these are risky, and how do you balance that? I'm excited, but also this is making me nauseous. How do you decide to pull the trigger? What kind of data, what kind of diligence do you do in making these bets?
I mean, it obviously varies with sector, right? But I think at the end of the day, the earlier stage it is, so like in biofuels in Brazil, for instance, where we have a very large project and an emerging market, the amount of work that goes into it is tremendous. So I think if you think about the project we're just launching now, where we're doing sustainable aviation fuel from a native crop, we have spent over 3 years in diligence on this project. So it is a tremendous effort, and I think hundreds and hundreds and hundreds of people working on it nonstop for 3 years before we get to the point where we're comfortable with everything, whether it's the regulatory part, whether it's dealing with the government, ensuring the right support, ensuring the right regulation, doing all the testing of the product. So it is a very manual project and a very manual sort of investment process. But I think that is also what, at the end of the day, our investors pay us to do. Right? We have to.
And you visit the customers. You go hear the reality of what the product itself is doing. You're sitting on the ground. You're sitting in the lobby of the building, watching people come in. Do they have smiles on their faces? Do they not? Are they frustrated? What kind of people come in? You look at the list of, in the old-fashioned way, you used to sign in for who goes to what building. You get a sense of what happens, and you have to immerse yourself in this stuff, because we are responsible for other people's money. And if other people are going to entrust us as fiduciaries of their money, it is the single most important thing we do, which is we unturn every single rock we can to make sure that as your stomach is churning on the things that you say, I've done everything I can to say yes or no. The hardest thing is actually saying no after 3 years.
Yeah.
Yeah. Maybe just to add on the point about diligence, I think one of the most overlooked aspects of diligence is actually really looking at what the locals are doing. I've been quite astonished, and actually, I'm sure this audience is perhaps relatively young, but when you're a person of a certain age, as I am, you will remember the 1980s and Brady's remarks and the issues around the Mexican debt crisis and a lot of other crises in Latin America. And one of the takeaways from that was actually there was a lot of evidence that locals were no longer investing in the markets. And so that to me is a dead giveaway. And so, using that as an additional tool of due diligence and just looking around the world and thinking about what are the pension funds doing? What are the endowments doing? This is supposed to be baseline foundational investors in an economy. And I'm just picking a region here, not a sector. I think looking at what is happening in that, it to me is always a great telltale sign. And I'm afraid, although I serve in the House of Lords, that I should be rah about the UK all the time. I mean, one of the things that we've been very concerned about is that pension funds in the United Kingdom only have 1.6% exposure in the UK market. I mean, that tells you a lot. about what's going on, and the country has been trading at a discount relative to the rest of the world for that reason. So I'm very interested in what are endowments and pension funds doing, and if you find that they're not investing in a particular market, and by the way, China is another example of where we hear a lot of stories about people, literally investors moving out of China. They claim to be investing in China, but they're based out of Singapore. I mean, I think these are telltale signs that we look back on later and say, well, actually, we kind of got a whiff that this was problematic. And by and large, when you ask, just in terms of flows and related to the point I just made, where are people putting money to work? It's coming back into the United States. And I think that also is a very basic and maybe obvious point to make, but I think it's very often overlooked.
And you mentioned Dambisa sits in the House of Lords, so she gets debriefed by MI6, by James Bond, who's kind of telling you what's going on.
As he damn well should.
Yes, as he damn well should. And you mentioned a lot of regulation and also discussion about AI that the House of Lords and just the government's doing. I'd love to describe a little bit of this, and then also from Oscar Mary here, we have to talk about AI. It's Iconoclast panel. And hear what you're seeing more on the ground level. So tell me about that.
I think superficially, I'm on record as being quite critical of the legislative approach, because I think, unlike the United States, I believe, places across Europe, so not just in Britain, but I think across Europe, we have decided that the word regulation is a synonym to risk mitigation. So, we think about these big juggernauts, as I said, these super cycles of AI and the energy transition, and too often it will come to debate in the Lord's chamber, and the discussion is about how should we be regulating this, but really with a risk mitigation frame of mind. Very different from what I would call an investor landscape, and I think Mary hinted at this. Sure, you have to think about risk, but at the same time, you want to lean into those opportunities. And when I think about my board experiences and how we think about really betting and putting the marginal dollar to work to generate returns above the cost of capital, you can't be thinking about risk in a sort of way to hamstring. If you're thinking about risk as a tool and an input to investing into these cycles. So I'm sure I'm going to get my finger wagged at me when I get back to London, but I do think there's a fundamental difference between looking at these cycles as investment opportunities versus as risk mitigation. I think too often in Europe, and I think this is reflected in the performance and multiples, too often I think there's a preponderance to think about risk mitigation in the regulatory environment.
What do you all think? Mary, you said...
Well, I think that the AI question, by the way, the whole day, if it's not filled with AI,
you get your money back.
Yeah.
If it's not filled with AI, then it's not infused in that part of the investment dialogue, and that should probably concern you. Because when you asked the question about due diligence, I was thinking to myself something I just wanted to weave in, and it naturally ties with AI, and we were talking about it a little bit before this. AI is technology multiplied by multiples of what it was. Like, it would be like not talking about the internet when the internet came out and thinking about, like, oh, could I have a website? Could I do like, if you aren't thinking about that and having that, like, are you really going to compete in the future world? That's what AI is. We don't know what it will be for every company. We don't know exactly how it will manifest itself. But if you are not deep into thinking about what your teams are doing, do you have I call it an AI whisperer? You need a 27-year-old, like, right by your side all day long, telling you, like, this is how I ask the questions, it's much better, I can be your instant prompt engineer training person, I can help you to figure out this stuff, and you start going through it. And this coming Wednesday, we have 31 demos that are happening. We have an AI workshop going on. And it's everything from getting rid of what I call no joy work. Like, who wants to wake up in the morning and do the same thing all day long? Do you know how much of the world functions that way? Nobody wants to do that. So it's not that AI is going to put that job out of business. AI is going to put that function out of business so that that person can actually go to work and have joy and do something that is like using their brain and actually adding value to the moving things from point A to point B. And so you start to, A, take away the no joy work. B, you start to think about, like, how do I delight my client? How do I delight my customer? How do I get smarter? Andreas was talking about how does he get smarter on making investments, like all of this, almost everything you do. And I say to people, if you're doing due diligence on a company and you go to meet the CEO, ask them if they have GPT, like, not just on their phone, but like on the home page of their phone. If it's not on the home page of their phone, they haven't substituted it for a simple Google search. They haven't infused it in the way. They don't have a 27-year-old sitting next to them telling what to do all day long. And you've got to have this to know these companies. Are they going to be able to figure out how to energy?
I've downloaded the app. I have ChatGPT.
Excellent.
That's half of our return generation.
But think about the energy businesses that you're invested in and the energy transition work that you're both doing. If you don't, AI is going to be a massive generator of how that gets much more efficient.
I think that's right. And I think everyone talks about it, whether it's open AI or a competing technology, and that's obviously tremendously important. But I think a bit of a winner takes it all kind of market. I think for us as an investor. And in terms of managing money, it's using AI to generate better returns is where I'm actually more excited at our level in terms of what we're doing. Our venture guys will disagree, and they're looking at the AI segment in general. But at the more private equity level of the businesses, it's the boring businesses that have started seeing the most impact from AI, at least in our portfolio. We have toll roads that
What'd you say, the boring businesses?
The boring businesses.
Yeah. Yes, exactly.
Like we have a toll road where by a simple computer system with active cameras or whatever, we were able to recategorize the traffic that went through, and it bumped our top line by like 7% on a toll road. Right? Yeah. So that's like real money generation. And I think someone said to me that AI will not displace humans. Humans that know how to use AI will displace humans that don't. And I believe in that. And I think that's how we try to embrace AI in our
And maybe I would just not to be the negative Nelly here, but I think we're all euphoric about GDP is going to grow by 17 trillion by 2030, productivity gains, which have been talked about here. But make no doubt about it, and I think Oscar just made the point, there are going to be winners and losers, and I think the great concern is that there is going to be a lot of carnage. I mean, right now, the rough estimates is about $130 billion of capital going into the AI space and different aspects of it. And just looking at where multiples are and what that would mean in terms of returns at 20 or 25 times multiple, you're talking about close to over $2 trillion of value being created every year. I mean, this is what's in the minds of investors. And sure, there will be winners. I really do fundamentally believe that. And I do think from technology adoption curves and a lot of the information that's out there already, it could happen much sooner. We don't have to build out enormous amounts of infrastructure. It's on your mobile phone, as you mentioned a moment ago, Mary. But I think it would be foolhardy from an investment perspective not to recognize that I do think there's going to be a lot of losses. And I think we just don't know where. I think there's a lot of work that's being done on the stack and figuring out, as I said, it's not just NVIDIA's, but what happens in terms of applications in other sectors, and the knock-on effects could be enormous. But there are also going to be a lot of losses, and I think people need to be very much aware of that.
Let me throw an interesting thing to try to, or at least I find it interesting, to tie AI and energy transition together again. Yep. And I think today we have slightly higher numbers than you had, but call it $150 billion going into AI on an annual basis, about 10 times that going into energy transition. And today we have, call it 10% of green energy share of the global energy consumption if you're being generous. With AI, there are a lot of forecasts now saying because of the intensity, the data intensity, the computing power needed, et cetera, that if you couple that with the general forecast for the planet, in reality, we're expecting energy consumption to potentially even double by 2050. That means from an energy transition perspective, if you can get, even if 50%, life's bad, right? So AI is actually accentuating the need for even more capital to flow, and that's why when we look at the investment, flows going forward, it's pretty clear that AI and energy transition is going to take a very large chunk of those capital flows and be very interesting. But it also highlights what we think is important is that when it comes to energy transition, the world needs to wake up and get off their high horses and start tackling real change.
You're very unique. Your definition of energy transition is different than a lot of these feel-good kind of funds. And tell everyone real quick specifically, what do you mean by energy transition?
For us, energy transition is about decarbonizing as fast as possible, and whilst generating return. I do fundamentally not believe that the world will get fixed by subsidies and tax breaks in industries that are not self-sustainable. If you want to see massive capital flows backing up an energy transition play, those capital flows need to make money, because those capital flows at the end of the day are the retired people and pension funds everywhere around the world. They don't make money. It's going to be a fringe activity to make people feel good. So I think the approach we've taken is much more sort of trying to put transition back into energy transition, take bad assets and make them good, as opposed to we don't touch bad assets. I think in fact the latter strategy is just detrimental to the whole energy transition. What
If we
happens
don't
is you
do
starve
that,
them.
we will not succeed.
Yeah, we cannot succeed, and it's even worse. You're starving energy-intensive companies from capital, pushing them into hands of people that manage them for short-term cash as opposed to long-term change. And I think that's the wrong thing to do. Yeah. So we're investing very heavily in this and trying to find, and we have one, we believe, in Brazil, a truly economically sustainable alternative that can take on fossil at its own game.
Yeah, and I think it's really, it's great that you've made that point, because I think in a strange way, the fact that the cost of capital has gone up, obviously in the fight against inflation, it's actually made the discussions around the energy transition much more sophisticated. In a world where money is free or cheap, people throw stuff on the wall, people become very disruptive. But the discipline, going back to due diligence in a world where it's expensive, is really forcing us to think about how we really are going to replace the fact that we are consuming 100 million barrels of oil every single day. And there still are 1.5 billion people who don't have access to energy in a reliable, cost-effective, and scalable way. So these are real structural problems that require real sensible answers and the allocation of capital in a way that's done in a very disciplined and smart way. And I'm afraid that that's actually happened more and more because capital's become more expensive.
Well, fortunately, we could talk about AI and energy for hours, but unfortunately, we're out of time. But a big round of applause, Mary, Oscar, Dambisa, thank you so much, and thank you.